In this video we are going to talk about dividend stocks to buy in 2022. So before starting, please like this video and subscribe to this channel for our future updates. To risk off from the recent stock market downturn and inflationary threat, many investors are turning to dividend equities. Because a company that can consistently pay out dividends to shareholders has a more stable balance sheet than one that is just focused on covering normal operational expenses. Unluckily for many modest investors, big dividend companies like Johnson & Johnson, ticker J&J, can sometimes exceed $100 per share. If you want something more affordable with a high yield, go no further than these 10 inexpensive dividend stocks to buy under $10 per share. Number 10. SunCoke Energy Inc., SXC. SXC has delivered since being designated one of the top small-cap dividend companies to watch in 2021 in March, with shares up 50% in 2021. The company focuses on coking coal rather than mining coal, and relying on power facilities that use this indisputably destructive fossil fuel. SXC has had a great start to the year thanks to robust industrial and construction steel demand from a recovering global economy. The company's usual quarterly payout of 6 cents per share was also unaffected by the pandemic in Q1 2019. Number 9. SFL Corp Limited, SFL. It manages roughly 80 vessels, including tankers for the worldwide oil and gas industry and dry bulk container ships for manufacturers and other enterprises. Due to global supply disruptions and general inflation, shippers have been able to command higher rates this year, including SFL. Even nominally cheap income investments can provide remarkable returns, as SFL's 15-cent quarterly distributions show. Number 8. Prospect Capital Corp., SEC. Prospect Capital, a BDC, is the next best buy for under $10. An investment firm that invests in other firms and then distributes a percentage of the profits to shareholders. And the SEC portfolio recently showed promise, with 50% gains in 2021. SEC's investments are diversified across sectors and focus on loans that provide steady premium payments to support regular 6-cent monthly dividends. Those 12 paychecks add up to a lot over a year. Number 7. Realty Income. Realty Income, commonly known as the monthly dividend company, is a solid investment. This is especially true for solid dividend stocks. Realty Income stock fell during the coronavirus correction in March 2020. Stock lost half its value from peak to trough. However, other stocks, sectors, and even the market as a whole have climbed. We've seen these assets rebound to pre-coronavirus levels. Except Realty Income. As if investors lost interest in REITs as the virus hit REITs. Even if the concern was overstated, the selling made sense initially. Investors feared huge segments of renters would be unable or unwilling to pay. Worries have grown as stock has risen. We can notice the dividend's consistency. A quarterly dividend increases for 96 quarters, and a monthly payment for 615 months, 51 years, 24 years. With a 4% dividend yield, this is a must-own for income investors. Number 6. Verizon, VZ. With a dividend yield of around 5%, Verizon is a dividend company to watch. This is especially true now that we've had a few major breakthroughs. For starters, the stock has fallen recently. I'm not sure why, but at NT's NYSET stock price action is unlikely to help. The sell-off's $50.86 low served as a guide for investors. Bulls can now bet on a bounce in the next weeks and months. If the stock breaks this level, investors can consider exiting the transaction. Things are improving when the company reported earnings. Verizon's third quarter profits beat expectations, and the firm raised its guidance on October 20th. This should boost investor confidence and allow them to stay in the market longer. Number 5. Lowe's. Lowe's hiked its dividend by 33% in May. Since the company went public in 1961, it has increased its dividend for almost 25 years in a row. That's 60 years of reliability. Like Target, the dividend yield is low at 1.42%. Long-term bulls, though, have been rewarded. Not only did they get a big raise this year, but the stock has done well over the last 5 years. Lowe's stock has risen 125% in 3 years and 28.3% in a year. This year, the stock has gained roughly 40%. An investor can only grumble so much when the stock is flying. Moreover, the sustained strength of the housing market has aided Lowe's performance. Number 4. Federal Realty, FRT. Returning to REITs, Federal Realty Investment Trust, NYSE, FRT, is a company to watch. This company, like Realty, is currently trading below its 2020 highs. This is one of the few high-quality stocks that hasn't fully rebounded from the coronavirus sell-off. Early in the sell-off, dividend investors saw the stock's dividend yield jump to about 5%. That's a very rare occurrence for Federal Realty. Before the coronavirus sell-off, it hadn't happened since the Great Recession more than 10 years ago. Despite the fact that the yield has lately decreased to 3.5%, income investors should still consider accumulating the stock with a yield of this level or higher again. Between 2011 and 2019, Federal Realty's yield went above 3.5% only once, in 2018. In August, the firm increased its dividend for the 54th time in a row. This is the REIT sector's longest streak of annual dividend increases. Number 3. Johnson & Johnson, J&J. For this list, we may choose from a range of companies, but why not start with Johnson & Johnson? Because the stock has risen after the company reported better than expected third-quarter profits. Investors were willing to ignore the company's revenue shortfall despite the fact that it had a revenue shortfall. This is most likely due to management's forecast for higher than expected earnings and revenue in the approaching quarter and for the whole year. Not to mention, J&J is currently riding high on the success of its single-dose COVID-19 vaccine, for which it has received full FDA approval. A second booster dose has already been approved by the FDA. Despite a recent drop in the stock price, this behemoth still has a market capitalization of $433 billion and a dividend yield of 2.6%. When it comes to the payout, it's a safe bet for investors. The firm hiked its dividend by 5% in April, marking the 59th consecutive year of increases. This occurred 1 year after the corporation raised its dividend by 6.3% in April 2020. Despite the fact that investor confidence was low at the time due to the COVID-19 outbreak, J&J executives made a point of stepping out and making an extraordinary effort to restore it. Number 2. Target, TGT. Target stock has made a remarkable rebound after a much-needed dip. Stocks had been on fire this year, up 43%, despite the latest slump. In the last year, the stock has climbed by 44%. In the previous 3 years, these gains have climbed by more than 200%. While some investors may be disappointed by the stock's low dividend yield of 1.45%, it's vital to recall how well it has fared. I'll take a sub-2% dividend yield over a 200% increase in the underlying asset in 3 years any day of the week. Target stock's recent gain could be just getting started as the holidays approach. For the year, analysts predict revenue growth of more than 12% and earnings growth of nearly 40%. The dividend yield may be modest, but it is not inconsistent. In 2019 and 2020, Target increased their dividend payout by about 3% per year. Then, in June, management delivered an unexpected shock, a wage increases of 32%. With today's announcement, Target is on track to increase its annual dividend for the 50th year in a row. Number 1. McDonald's, MCD. McDonald's is a solid dividend stock. A 7% increase in dividends in September brought the yield to roughly 2.3%. While not a high yield, it is notable in this low-rate environment. It's also notable for a stock that keeps rising. McDonald's stock has climbed almost 14% this year. So much for boring, huh? The stock recently hit an all-time high during the recent market collapse. More impressive than the 7% gain is the management's constancy. MCD's has raised its dividend for 45 consecutive years, since 1976. the company said after the most recent increase. We want to invest in renowned companies when it comes to dividend stocks. Projections show McDonald's has a bright future. Analysts expect a nearly 20% revenue gain and a 50% profit increase this year. In 2022, revenue and earnings growth of roughly 10% is predicted. What do you think about our video? Please let us know in the comments area below. If you enjoyed this video and would want to hear from me again, please subscribe and turn on the notification before leaving. Thank you for watching us.